There's a lot of misinformation about how to pay off a mortgage quickly. I'll tell you the truth about how to pay it off and warn you about the shady way most YouTube videos are pushing. You won't fall for these lame strategies that involve HELOCs, credit cards, and unnecessary mortgage acceleration plans. Most of these videos on YouTube, which have millions of views, are appealing because they let you believe you're getting something for nothing and can create money out of thin air. I don't want you to fall for these gimmicks. They don't work. I'll share with you 5 different ways to pay off your mortgage faster, which ones I use to pay off a mortgage in 7 years, and then go into more detail about why the mortgage accelerator programs all over YouTube are a waste of money. Let's get started. For the purposes of sharing my 5 strategies, we need a fictional house to buy. Let's assume we're buying this house with a mortgage of $500,000, 5% interest rate, 30-year fixed. Just so you know, the mortgage amount is $2,684 a month, and the total interest over the life of the loan is $466,000 and change. We're going to start off with small, easy methods that anyone can do, and end with the method that makes the biggest difference in paying it off quickly. Method 1. Pack a goddamn lunch. This assumes you eat out lunch on a regular basis at work, and now you've decided to pack all lunches. Take that savings and apply it to paying off your mortgage faster. Let's assume that the savings of not eating any lunches out is $200 a month now put towards your mortgage. You pay off your loan 14% faster, saving 4 years and 3 months and $77,000 in interest. All that for packing a lunch? Hell yeah. That's huge and anybody can do this. Let's take this a step further. What about no lunches and no coffee from Starbucks? I know, it's probably not worth that sacrifice, but let's just calculate it. I'll estimate the savings for making your own coffee another $100 on top of the $200 for lunch. $300 towards your mortgage pays it off 20% faster, saving 5 years and 11 months, practically 6 years at $106,000 in interest. Giving up Starbucks saved you about $30,000 in interest over the life of the loan. You can see it's very easy to pay off your mortgage much faster by finding these small places to save and adding it to the loan principal. Let's try something else. Method 2. Bi-weekly mortgage payments. This is a simple concept. You make half of your monthly payment every 2 weeks. By the end of the year, this will result in 26 half payments or 13 full monthly payments. Essentially, we're sneaking in an extra house payment of $26,084 a year. Let's see how much this helps. This method is 16% faster, saving 4 years and 10 months and $88,000 in interest. That's pretty helpful, almost 5 years earlier for just 1 extra payment a year. Let's see how much better we do adding more house payments per year. Method 3, an extra house payment per quarter. Making an extra house payment once per quarter is 4 extra house payments a year, $894 extra each month. This will probably pay things off quite a bit faster. Let's take a look. This pays it off 46% faster, saving 12 years and 6 months and $216,000 in interest. Yep, that's pretty fast. You've almost changed a 30-year loan into a 15-year loan. In fact, that's the next method, the Pretend Refinance, and this is my favorite. Let's see how much more money it takes to pay off the loan twice as fast. Let's pretend our loan has changed from a 30-year fixed to a 15-year fixed interest rate. You'll increase your monthly payments to the new amount and pay off the loan twice as fast. We are pretending to refinance the loan from 30 to 15 years. Normally, this would have significant fees and would change the amortization table and minimum payment. We're not doing that. We're pretending to refinance, voluntarily paying the higher monthly rate that pays it off in 15 years instead of 30. You don't have to double your payment to pay it off twice as fast. It isn't linear. It's actually quite a bit less than double. The current monthly payment is $26.84. If you raise that amount by not double, but just 47% or an extra $12.70 a month, that's $3,954, you pay off the loan in half the time. I'm not trying to say this is easy. It would be impossible for most of us. But if you can find a way to come up with that extra amount each month, like saying spouse takes a job or you find an extra source of income, or both, you cut your payoff time in half. This method is 50% faster than normal, with $254,000 saved in interest over the life of the loan. Pretty awesome. Another benefit of this method is that it is not permanent. You aren't committed to these higher monthly payments. If you refinanced, you'd be committed to the new higher minimum payment. With a pretend refinance, if you have a financial emergency and need to take a break from this repayment schedule for a few months, no problem, no penalty, no late fee. Just go back to your minimum 30-year payment until you're able to resume the higher payment. Now here's the method that usually makes the biggest difference. It did for me. Method 5, put your windfalls into your mortgage. In my case, I'd already paid off all my other debt, maxed out retirement accounts, and had been saving money in taxable accounts. I got it in my head that I wanted to pay off my mortgage, so I went for it. With this method, you take large chunks of money that you might get from time to time and throw it at your mortgage instead of a vacation, nicer car, or bigger house. The kind of windfalls that can go towards a mortgage are things like end of year bonuses, income tax refunds, inheritances, payouts from insurance claims, money from selling valuable items like jewelry, cars, rare record collections, baseball card, crypto, the money I get from posting on OnlyFans, link below, don't forget to hit like. You may also decide to devote all the money from a raise towards your mortgage. You could also use the money from a side hustle or second job. I started flipping houses and used all that money towards paying off my mortgage. It ended up being a huge help. I also sold my stock portfolio, which had been doing well for several years, to get the last $10,000 I needed to pay things off. For me, I paid off the mortgage in 7 years. It may take you longer or shorter. Everyone's situation is different. So that's how you pay it off faster. I wish I had a secret hack that could create money out of thin air. Speaking of which, now what about these mortgage accelerators that use HELOCs and credit cards to save money on interest and pay off your loan faster? Well, it certainly has gotten a lot of attention here on YouTube. There are several videos with over 1 million views that talk about these mortgage acceleration plans. I'll save you a lot of time and summarize what these payoff quick video scams are saying. You can thank me by subscribing. We have our fictional $500,000 mortgage. Instead of paying extra money towards it each month, we get a HELOC, home equity line of credit, for $100K, and pay the entire amount towards the mortgage all at once. Hell yeah, we are clearly paying off our mortgage much faster now. It's reduced to $400,000 in an instant. Yay, but we still have a new loan of $100K of HELOC to pay. Boo. The HELOC probably needed appraisals and fees to set up. That's not good. And also probably has a variable interest rate higher than our fixed 5% rate. Also not good. But wait, there's a silver lining. What if your HELOC replaces your checking and savings account? You completely change the way you spend money. What if you put all the money in your checking account, savings account, and even had your paychecks paid into your HELOC? That would keep the balance below $100K, and interest is calculated daily off the balance versus monthly with a mortgage. This does present the possibility that you come out a little ahead this way. You pay all your bills from your HELOC and you put all income directly towards paying off the HELOC. That's the trick. Some people even use new credit cards with temporary 0% interest to further accelerate this. This keeps the average daily balance much below $100K. Salesmen make this sound amazing, but the savings, while it does exist, isn't anything that's substantial. Maybe a couple hundred a year at best, and there are a few pitfalls. 1, HELOCs can be canceled, like in the last real estate crash in 2008, or in the next real estate crash due any freaking day now. 2, HELOCs are subject to interest rate risk. They are a variable rate and could raise high if luck is not in your favor. 3, there are fees involved with getting a HELOC, and sometimes additional fees for joining a mortgage acceleration program, which has more complicated and unnecessary bells and whistles in addition to the HELOC. 4, if you don't earn more than you spend, and that can be bad luck, bad habits, or both, you'll just get further behind with this HELOC method than you would have without it. You'll have higher interest costs in addition to the fees from getting the HELOC. 5, it's a pain in the frickin' ass to implement. Look, this HELOC scam is similar to infinite banking or other bastardized forms of whole life insurance. See my video. A smooth-talking, greasy salesman convince you you're coming out ahead, but you're not. Enough of that. It's crap. Don't do it. Now, should you pay off a mortgage? If you're watching my video, and I can't believe you still are, you probably think you should pay it off. Maybe you worship Dave Ramsey, or maybe you just like the peace of mind. Let me list the cons of paying off a mortgage first, just to make sure you're thinking through this clearly. Then the pros. Maybe I've got one or two you haven't thought of. Cons, the mortgage hedge on inflation. This is by far the most important but least understood negative side of paying off your mortgage early. When you spread out a fixed payment over 30 years, that fixed payment becomes cheaper every year because of the effects of inflation. For this reason, a mortgage is actually a hedge against inflation. If you use a present value calculator, you can see what your mortgage payment at the 27-year point will be worth in today's dollars. At a 3.5% inflation rate, a $2,000 monthly payment, 27 years in the future, is only $846 in today's dollars. Something to consider. Next con, leverage tends to make more money over the long term. Let's take two scenarios. In one scenario, you buy a $50,000 house for cash. In the other, you make a $50,000 down payment on a $250,000 house. If things go normally over the long term, you will have more cash flow and build greater wealth using the 30-year loan with low interest rate than you would have buying with cash. This is because of the power of leverage. When the price of your house raises 10% in a given year due to high growth in the area, you gain $5,000 of value in the cash buy, but $25,000 of value in the mortgage buy. You control more money because it's leverage. The same is true with cash flow. Next con is opportunity cost. Paying off a mortgage is a low return on investment. You only save the interest rate. You lose the opportunity to invest that money in something else that potentially could make a lot more money than your fixed interest rate. Let's talk pros. A guaranteed risk-free return at whatever the interest rate is. These will typically beat the return on bonds, CDs, and treasuries. If your mortgage interest rate was fixed at 5%, you are guaranteed to come out 5% ahead in the future by paying this loan off early. Another great reason is the peace of mind it brings to not have a mortgage payment that must be paid every month. You have an almost free place to live, still got to pay taxes, insurance, and upkeep, and know that you won't end up losing your house to foreclosure if something weird happens with your income in the future. Next is asset protection. Several states have special rules that protect home equity in the case of a lawsuit. Homestead rules in many states protect the equity in your home up to a certain limit. This is a protection not afforded to most asset classes. Home equity is unique in this sense. So, should you pay off your loan quickly? That's a personal decision. I paid mine off and don't regret it. But if you do the math, I could have come out way ahead investing that money in index funds instead. But psychologically, I love the peace of mind of having it paid off. For me, it's not the financial decision, it's an emotional one. I've got lots of other videos about real estate and investing in general. You better subscribe to my goddamn channel. All right, look at my recommended video here and see what YouTube seems to think you might like from my collection. Thank you. This is Rich on Money, signing off.